I can see a lot of familiar names have joined us today, which is great. So today I represent World System Builders, or WSB, a financial group which operates in North America. So we have a mission to educate 30 million families by 2030. Let's move to our presentation. Finance 101, Saving Your Future, Basic Principles of Building a Financial Foundation. First of all, the disclaimer: the information in this presentation should not be interpreted as accounting, investment, legal, or tax advice. It is not an offer to sell or a solicitation to buy any security, insurance, or any other financial product. This workshop is for educational purposes only. Our national campaign for financial literacy is to bring financial awareness and education. You will not learn everything during the course of this workshop. However, we hope you learn, gain more confidence, and take action toward reaching your goals. Being part of our campaign, we encourage you to help empower others to do the same. To help us preserve the integrity and context of the information, please do not take any photos, videos, or record this workshop. I believe the chapter is recording this session for you. So with that, these days, people are facing so many challenges. Some are not interested in their financial future, ever increasing debt, living paycheck to paycheck, no emergency fund, not having enough goals, spends a lot, and not having a budget. Bad habits and poor decisions can add up. What do the wealthy know that rest of us do not? In addition to those challenges, people are living longer as well. As a result, today's world faces these challenges in an aging world. Lower birth rates, more single parents, increasing health concerns, lack of appropriate housing and supervision, transportation and mobility issues, wealth transfer and health directives, and financial security. You can see in this chart the total life expectancy at birth. In 2023, it's somewhere around 82 years of age. In 2030, it is expected to be somewhere around 84. In 2060, it will be somewhere around 88. I think most of you know, in Canada, we have an aging population or an aging workforce. In fact, that's why most of us are here in Canada, because Canada wants to replace their aging workforce with people like us. In Canada, people start work very young. In most of the provinces, you can start work from age 14. But we came to Canada in our late 20s, in 30s, maybe even in our 40s. So we started late already. When you start young, you will be able to contribute to CPP, Canada Pension Plan, or group RRSPs, group Registered Retirement Savings Plans, or maybe even build your own savings, personal savings, which as immigrants won't be able to do as natives because we started late. To get the maximum out of CPP benefit, you have to contribute for at least 39 years. If we migrate in our mid-30s or even late or even in 40s, we won't have enough time to contribute fully to CPP, Canada Pension Plan. Even if you contribute for at least 39 years, the maximum benefit you will get from CPP is somewhere around $1,400 per month during your retirement, which means in Vancouver, you won't be able to pay even your rent. I think it will be the same in Toronto as well. So as immigrants, we have to be mindful how we gonna spend our retirement after age 65. If we gonna live on, up until age 85, how we gonna survive that 20 years? If we cannot get the maximum out of CPP benefit, if we can't build enough group RRSP savings or personal savings. I want you to think second half of your life, not tomorrow, but today. So keeping that in mind, hopefully towards the end of this presentation, I will be able to provide you some solutions to increase your savings for your retirement. So the main topic of today's presentation, building a financial foundation. Building a financial foundation is like building a house. You can't think about building a roof without proper foundation. In financial foundation, the base is proper protection. Not just protection, proper protection. In Sri Lanka, in our home country, we had our parents, siblings, and close friends to support us. If something happens, if something goes wrong, they are always with us to help us or our families, right? But now you are living thousands of miles away from home. If something happens to the breadwinner or the main income earner of your family, let's say premature death, right? Imagine if the surviving spouse have to think about how to pay next month's rent, how to pay next month's car payment, how to pay next month's grocery bills, while in his or her darkest hours of life, after losing someone you love. You can't expect someone else to look after your family. You can't expect your surviving spouse to go to start something like GoFundMe project, right? You can't, even worse, you can't expect your surviving spouse and children to go back to Sri Lanka after forgetting their Canadian dreams. So that's why you need to think about proper protection. Thinking about proper protection is like thinking about how to take care of your family. So that's how important proper protection is. Next, we're going to discuss about debt management. I'm going to tell you about a method called roll-up method. We also call it a snowball method, which will help you to pay your debts quicker than if you pay only minimum monthly payments. Next, we're going to talk about emergency fund. In Canada, the norm is to build at least 6 months of expenses as an emergency fund. Because in Canada, job security is very low. So even if you lose your job, you need to have enough money to support yourself until you find a new job. And also, sometimes as immigrants, we may have to send some money back home, right? So in that case, it's better to have some money as an emergency fund rather than taking money out of your line of credit, because in that case, you will have to pay interest for that. Finally, I will talk about investment options available for a regular person. Normally, we recommend to have at least 20 times of your annual income as investment, because as I mentioned earlier, if you're going to retire at age 65 and if you're going to die at age 85, you need to survive for 20 years, right? So we can link proper protection to investment using this X-curve concept. You can see here there are two curves. One represents your responsibilities, which is taking care of your family, and the other one is taking care of yourself. If you do not take care of yourself, who will, right? So when it comes to deciding the right amount which you need to take care of your family or to have a proper protection, we use a method called DIME method. D represent debt, I represent income, M represent mortgages, E represent education. So in Canada, even if you die, your debt won't disappear. It will be on your family's soul. So that's why we need to include debt when we consider proper protection or insurance coverage. We recommend at least 10 times your annual income to be included in your insurance coverage or insurable need as well, because that will give your surviving spouse some time to get financially stable. And if you are paying a mortgage along with your spouse, definitely you will have to include mortgage. The reason is, if both of you are contributing to pay off the mortgage, if someone dies, the whole responsibility will be on the surviving spouse. It will be too much, and at the end, she will have to go to streets with the children. So that's why including mortgage is important when you're calculating the insurable need. Next, children's education. No matter what, under any circumstances, children's education should not compromise. If you don't have children, he will represent the state. Next, taking care of yourself, which means over time, when you get older, you have to take care of yourself. You need to have enough money to support yourself during your retirement. For that, you need wealth. You can't have wealth without putting in money, and you have to give some time for money to grow. And you need to have good rate of return as well to beat inflation and taxation. If you're able to do that, you will have enough wealth. We call this 10 to 20 formula. You may need 10 times of your income to protect your family, and you may need 20 times of your income to take care of your future retirement. But actually, when we say that 20 times of your income to take care of your future retirement, it should be even longer than that, because even more than that, because in here we haven't taken into consideration the time value of money. And also, if you're going to live longer, obviously you will need more than 20 times of your income as for your future retirement. Now I'm going to discuss about insurance options that are available to you. There are two main types of life insurances. One is term, another one is permanent. So the main difference between term and permanent is the cash value. Permanent insurance have a cash value. So it also represent investment along with proper protection. So other than if we disregard term, permanent insurance is a good tool. It's a tool which can be considered as a proper protection tool as well as a investment tool. Now let's talk more about term insurance. Term insurance is more like your car insurance. It's an expense. There's no any cash value involved in it. So you can have different types of terms like 5-year, 10-year, 15-year, 20, or even 75-year terms. And it's the cheapest option. Since there's no any investment option involved, it only gives you a coverage. Normally, we recommend, even if you're going for a term insurance, we recommend to have a coverage up until 65 years of age. So that way, you will have a coverage until your retirement. So in this example, you can see this person, a 30 years old female, has taken a coverage of 500,000 for 20-year term. So up until age 49, she will have that 20-year coverage, and she will only have to pay $400 as the premium. But the issue with term insurance is once the term is over, and if you are older, then your cost of insurance will go up. Cost of insurance will result in premium amount as well. So if the cost of insurance increases, premium will increase as well. So you can see after age 50, if she's going to have another term insurance, her premium will be more than $2,000. So that's why it's important to go for insurance at young age as soon as possible. So that way you will have a lower cost of insurance, which means lower premium. So what are the other forms of term insurance? Normally, most of the employers provide group life insurance for the employees. The benefit is usually 1 to 3 times salary. You do not need to qualify, and is also inexpensive. However, there can be a waiting period. Normally, the waiting period is the probation period. So after the probation period, you will be eligible to group life insurance if there's any available. And employer can change the plan at any time. And also, if you decide to find another job, if you quit from your job, then of course your insurance coverage will end. It will be terminated on the last day of your stay with your former employer. So that's why it's important to have a personal insurance, even though you have a group life insurance. So normally group life insurance comes with accidental death and disbursement as well, which is inexpensive but may not be of good value. Certain conditions must be met to realize the benefit. So it depends on the coverage you have with your employer. So what are the advantages of term insurance? As I mentioned earlier, term insurance does not have a cash value or investment portion. As a result, it's very cheap and coverage liability for a specific amount of time. So if you are starting your life here in Canada, and if you think that you need a insurance coverage, I would say term insurance is a good option because it will have a coverage uh, up until you get settled in Canada. So when it comes to disadvantages, only insurable for a specific amount of time. Policy will lapse if premium payment is missed. So this is a difference between permanent insurance and term insurance, because in permanent insurance there are cash values. So which means even there are lapses in insurance premium payment, after some time policy will take money out of the cash value and make sure that policy will intact. But in term insurance, since there is no any cash value, if there are any lapses in premium payment, policy will also lapse after some time. Premium is wasted if you don't die within the term. This doesn't mean that you have to die, but that's the way it is. Becoming uninsurable forces you to renew at high rates. In that example, you have seen that premium increases at a certain age. After age 50, premium increases rapidly, and policy cannot be renewed beyond a maximum age. This can differ from one insurance provider to another, but after a certain age, you won't be able to renew your term insurance policy. Now, let's take a look into permanent insurance options you have. There are two main types, whole life and universal life. So whole life insurance policy keep you for whole life, which is exactly what it means. So which means you have a coverage for entire your life, and part of the premium will be will create a cash value, which is the investment portion. So when it comes to features of whole life, premiums are fixed. You can have paid up feature as well. Low guaranteed interest rate on the cash value. Cash value accessible through withdrawal, surrendering policy, or taking policy loan. But if you surrender the policy, there can be tax implications, as well as you won't have a policy thereafter. So we don't recommend surrendering the policy. If you want to access cash value, you can use withdrawal or policy loan option. Policy may receive dividends, which can be used to lower the premium, buy more insurance, add to the cash value, or be paid back to the owner. When it comes to advantages of whole life insurance, guaranteed interest rate, pay schedule, 10 pay, 20 pay, pay to age 100, can be designed prior to issue. Permanent policy designed to last your entire life, and tax advantage growth. This will be covered later in the presentation as well. And when it comes to disadvantages, guaranteed interest rate tend to be conservative rate, and the premium is fixed. Now, let's take a look into universal life insurance, which is the most, I would say, one of the most popular proper protection option you have, because this is kind of a hybrid option. These have features of term insurance as well as whole life insurance. So the main difference is the premiums are not fixed. You have a range, you have a maximum limit as well as minimum limit. You can decide the premium from there, and the death benefit can also be flexible. So as I mentioned earlier, when it comes to features, the universal life has flexible premium with a minimum and maximum limits. So some of the premiums pays for the cost of insurance. The rest of it gets invested, indexed third-party investment funds. So if you pay close to maximum amount, it will get invested in the cash value. So your cash value will get accumulated more if you decide to pay more premium. And the cash value get invested in third-party investment funds, which is almost similar to mutual funds. So instead of investing in mutual funds, you can use universal life. The reason is, in mutual funds, it will government will tax you then and there, but in universal life, you will not get taxed, and in the same time, you will have a coverage. So if you want to invest in shares or in mutual funds, I would say universal life is one of the best option because you will have the coverage as well as you will have the tax advantage. Allows flexibility of investment choices. You can decide what are the funds that you're gonna invest in, and can access cash value through withdrawal or policy loan. This is similar to taking a loan against fixed deposit in Sri Lanka. So you can use this cash value for your for an investment of another business, like or even to purchase a house. You can put cash value as a down payment, or you can use this cash value as a retirement fund. So you can use this cash value for different options, and you don't have to pay taxes when you withdraw or take a policy loan, or when you access cash value in simply. So when it comes to advantages, as I mentioned earlier, premiums are flexible. Death benefits also can be flexible, like you can change it if you want. Permanent policy designed to last your entire life. So you will have a coverage for your entire life, and you can access the cash value. Tax advantage growth, similar to whole life. And when it comes to disadvantages, underfunded policies may require additional premiums later in life. This can be avoided if your insurance agent or the financial advisor take into account worst case scenarios. So it's up to the agent. So if agent be cautious when preparing the illustrations, when providing the solution, this can be avoided. Same with this, the guaranteed interest tend to be a conservative rate. So it's up to you on which kind of funds that you're going to invest. If you invest in, it's based on your risk portfolio as well. If you select correct funds, you can have a guaranteed interest rate as well. So additional benefits or riders. Riders is something which you can add into your life insurance to for a fee. So when it comes to most common riders, additional term, critical illness, disability. We will discuss more about critical illness and disability next. Waiver of premium, child rider, and guaranteed insurability. So these are the rider options available to you, which you can add to your life insurance. Next, the critical illness. I would say if you have a family history with critical illnesses, I would suggest to go with critical illness insurance separately, or at least add as a rider to your life insurance. In Canada, we have mainly two types of critical illness options. Some insurance options will cover up to 25 of critical illnesses, and some option will cover 4 critical illnesses. So based on your budget, you can decide which option should suit you the best. But definitely, if you have a family history with critical illnesses, I would suggest you to go with the critical illness rider, or separate critical illness coverage. Some critical illness plans offer access to leading medical experts to review your diagnosis and give you a second opinion. When it comes to disability insurance, what if I become disabled and cannot work? If you become disabled because of sickness or injury, having a disability policy will pay you a monthly amount. Typically, up to 60% of your net income. Employer or group plans will pay out first before individual plans kick in. So we normally recommend disability insurance for those who work in harsh weather conditions or dangerous work environments. For example, professionals like warehouse workers, chefs, truck drivers who are getting more exposed to risk. I would say for those people, it's better to have a disability insurance. This doesn't mean that others do not want to have, like, do not have, should not have disability insurance, but definitely those people who are getting more exposed to risk should have a disability insurance. If you are a business owner or self-employed professional, do you have a safety net if you cannot work for an extended period? Can you say, can your savings last 1, 3, or possible 10 years? So you will be able to survive during your disability. Those are the things which you need to consider. Next, additional benefits or taxes. There are several tax advantages to life insurance. So in life insurance, if the insured person dies, the beneficiary will get the death benefit tax-free. The beneficiary won't have to pay a single cent of tax to the government. And tax-free living benefit, which means if the insured person, this mainly applies to the permanent insurance, actually, whole life or universal life insurance policies. If the insured person become disabled or critically ill, he or she can have access to a cash value without having to pay any taxes. This is what we call a tax-free living benefit. Tax deferred growth of cash value in permanent policies. So whatever you invest in permanent life insurance policies, the benefit will get tax deferred, so you don't have to pay taxes for the cash value. Income tax free access to cash value in permanent policies through policy loans. So you can withdraw cash value through policy loans, and when you do that, when you use policy loans to withdraw cash value, you don't have to pay any taxes, and you can use those funds to invest in a business, to purchase a house, or you can use any other thing you want. So basically, it is almost like taking a loan against your fixed deposit in Sri Lanka. And the other thing is tax-free withdrawals of cumulative paid premiums. Note, if the policy is cancelled, you may be subject to taxes on policy gains. So if you surrender your policy, of course, whatever the gain you had in your cash value will be taxed. So, and obviously you won't have any coverage thereafter. So this, the surrendering policy is not recommended at all. In addition to those insurance options, you have health and travel insurances as well. So health insurance can cover prescriptions, dental, and vision. Your employer may provide this. However, what happens when you retire? What if you're self-employed? So you need to take these into consideration as well. And next, we're going to talk about travel insurance, which is very popular among our community because most of us have our parents visiting us. So it's highly recommend to have a visit visa insurance if your parents wish to visit you here in Canada, because medical expenses are really high. Even one day stay at hospital can cost you more than $8,000. So it's highly recommend to have a visit visa insurance if your family or friend are visiting you in Canada. There's another insurance called super visa insurance for citizens and permanent residents. You can invite your parent or grandparent to visit you in Canada using super visa options. But when you submit the application, super visa application, you need to have a super visa insurance as well. So in super visa insurance, you need to have at least 100,000 coverage for minimum 1 year period. Next, we're going to talk about mortgage insurance. So when I say mortgage insurance, I'm talking about mortgage life insurance, not mortgage loan insurance. Mortgage loan insurance covers the lender in case of a default. But here we talk about mortgage life insurance. Mortgage insurance will pay off the mortgage if you should become seriously ill or die. Unfortunately, it's not as clear cut as life insurance. Bank staff may not be properly licensed or trained. Premiums usually stay the same, though mortgage decreases. You may be paying premiums, however, underwriting and qualifying happens when you die. For example, if you have high blood pressure, it can be a possible reason for not getting qualified for the death benefit. So this is why we recommend to have life insurance instead of mortgage life insurance, because in mortgage life insurance, they only cover the mortgage. But in life insurance, we cover other factors as well. As I explained to you before, we use a method called DIME method. In the DIME method, we consider other debts, income, mortgage, as well as education of your children. So we consider all these factors when we decide the coverage of a life insurance compared to mortgage life insurance, which will only cover the mortgage amount. And normally banks can't offer insurances in Canada, so they have to get the help of a third-party insurance company, which will end up increasing your premiums. So if you go for a life insurance directly with the insurance company, your premiums will be lower, and obviously you will get a higher death benefit, which surviving spouse or the beneficiary can use to pay off the mortgage. Next, let's talk about debt management. In Canada, especially among newcomers, credit card debt is one of the most critical issue. The average Canadian is more in debt than ever. Overall, household debt reached well over 2.2 trillion Canadian dollars, including mortgages. Canadians carry an average credit card debt balance over $3,330 month after month. Part of the overall average is more than $20,000 without mortgages. So in this slide, I'm going to talk about the cost of debt. In here, there's an example. For example, let's say you have 5,000 in credit card debt. Minimum payment is $200. APR, annual percentage rate, is 19%. So of that $200 minimum payment, $78 is paid toward interest, and only $122 is actually going toward the $5,000 of debt, which means you will pay $3,136 in interest, and it will take 138 months to pay off, which is almost like 11 and a half years, assuming that this $5,000 credit card debt won't increase. What's the real cost of debt? Imagine having saved that $5,000 and you were able to save that $78 which you were putting in as interest, right? So that $5,000 plus $78 which you were paying for interest at 8% for 30 years, you will end up saving 156,000 Canadian dollars. So this is just one example how the rich get richer, and how the poor get poorer. So if you can avoid paying credit card debts, you will end up saving some money, which you can use to build up your emergency fund and also your investments and savings. Make a plan to live debt-free, live within your means, and not increase your debt. Understand how credit card works, APR, minimum payment, and etc. Don't apply more credit card or high limit, especially if you don't have any control over your spending, or if you lack discipline when it comes to spending. Many credit card issuers allow you to freeze your credit card to prevent new purchases on your account. Now I'm gonna discuss about a method called debt roll-up method, which we can use to pay off our debt sooner. So this method is also called snowball method. It's a systematic approach of paying more than the minimum. As soon as the first balance is paid off, the freed up payment amount is used to pay down the next debt even faster. So there are two approaches for this. You can pay off the highest interest first, or you can pay the smallest balance first. This is a mathematical example to explain the debt roll-up method. So in here, you can see this person has several debts. There's a mortgage, there's a bank loan, auto loan, MasterCard, Visa, home improvement loan, and another 2 credit card loans. So altogether, the total debt is more than 401k. 1k. And if we only pay minimum monthly payment, this person will have to pay $2,857 per month. And if we only pay the monthly payment, you can see here, this person will take 361 months, which is almost like 30 years. Let's say this person able to find another $100, and which he or she can use to pay this debt. So first, he will use this $100 to pay off the final credit card amount, which is $150. So he has been paying $10 as minimum monthly payment. Now with this additional $100, he will be paying $110, and instead of paying it for 19 months, he can end up settling the credit card within 2 months. For the next credit card, he can use this $110 plus the minimum payment which he was paying earlier. So altogether, he can contribute $135 towards this credit card balance. So instead of paying for 27 months, now he can pay off the debt within 6 months. Similarly, for the home improvement loan, he can use $135, which he was able to free it up by settling the last 2 credit cards, plus the minimum monthly payment which he has been paying for home improvement loan. He can pay $185 towards this home improvement loan, and he can settle this within 12 months compared to previously 38 months. So likewise, he will be able to settle all these loans within 17 years compared to previously 30 years. So this is how the debt roll-up method works. Did you know an extra $100 per month can dramatically save time and reduce your debt? So the next question is how you can find that extra $100. Well, there are a few options. You can ask nicely for a raise. I don't think it'll work, but you can try anyway. You can work overtime. You can work a part-time job. However, I'll tell you how I found my $100. What I did was I started a part-time business. This is my business. So I have my full-time job. In addition to that, I started this part-time job, part-time business rather, which helped me to find an extra income, which I can use to pay off my debt sooner. I will discuss more about this option later in this presentation. Today, there are many opportunities. Just remember to never lose sight of your goals and reason why. Will you shrink your dream to fit your income or increase your income to fit your dream? The choice is yours. Now, let's talk about the emergency fund. As I mentioned earlier, in Canada, we normally recommend to have 6 months of expenses as your emergency fund. The reason is in Canada, job security is very low. You can lose your job at any time. So you need to have some money with you in order for you to support yourself until you find a new job. So what are the features that are necessary for an emergency fund? The principal should be protected from losses. So if you invest your emergency fund in stock market, you won't be able to withdraw money at time of emergency, as well as you won't, it won't guarantee you that you will get the principal at the time you want, right? So one of the most important point is the principal should be protected from losses. So when you're building an emergency fund, you should not invest your emergency fund in risky investments. And the money should be accessible, which means it should be cashable. So if you put your money in a locked in saving account, you won't be able to access your money at the time you want during an emergency. So you should be able to put your money in a account which you can access easily. And at the same time, you should not use this emergency fund money for day-to-day activities. So what I would recommend is to have a separate bank account which you are not using on day-to-day basis. So that way you won't access emergency fund for day-to-day operations. Next, I'm going to talk about rule of 72. This is a rule which we can identify or which we can explain to see how much of years we need to double our money, to double our investment. So in here, what we do is we divide 72 by rate of return. So in this first example, if the rate of return is 6, it will take 12 years to double our money. So if the initial amount is 10,000, it will take 12 years to get 20,000. It will take another 12 years to get 40,000 for our initial investment. And it will take 36 years to make it to 80,000. Likewise, in the next example, if your rate of return is 8, it will take 9 years to double your investment. So in this example, it will take 36 years to get 159,000 after doubling your money after each 9 years. The next example you can see, if your rate of return is 10, it will take 7.2 years to double your investment. So you can see here, rate of return can have a big impact. At rate of return at 6, after 36 years, you will get 81,000. Rate of return at 8, after 36 years, you will get almost 160,000. Rate of return at 10, you will get almost 309,000, which has like a huge difference. However, we only discuss about rate of return, but we need to take into account the real rate of return, which means we have to take into account inflation as well as taxes. So if you save $100 at 5% interest, and if you pay 25% as your income tax, you will end up after tax amount of $103.75. However, if the inflation is at 3%, you will lose $3. So the actual return would be $100.75. So the actual rate of return would be, or the real rate of return would be only 0.75%. So that's why if you are going to invest in TFSAs, and if your TFSA only will give you 3%, you won't have any tax implications. But if the inflation is at 4%, you won't be gaining any money. Actually, you will be losing money. So that's why you need to consider a rate of return when you deciding where to put your money in. So this is another example. Assume your income is 60,000 per year, and you set aside 10% per month into an account that grows at some interest rate. So 60% per year means 5,000 per month, and if you set aside 10%, it will be $500 per month. If you think that $500 is a huge amount, you can break it even further, $17 per day. But when you look at it, you won't think that it's a huge amount, right? But if you're able to put this $500 per month at 8% for 30 years, you will end up getting 745,000. If you put this $500 per month at 10% for 30 years, you will end up getting 1.1 million. So you can see how much of a difference it can make when it comes to rate of return. So with discipline and budgeting, Anyone can achieve this. So now let's come to investment. Let's talk about investment options you have. I would categorize investment options based on the tax implications. There are tax now investment options, there are tax later investment options, and there are tax advantage investment options. So saving, GIC, stock, mutual fund, bond, interest income, non-registered investment, all are tax now in investment options. So if you able to get a gain, you will get taxed right away. But there are tax later investment options like RRSP, IRA, RESP, annuity, pension, CPP, OS, or RDSP, Registered Disability Savings Plan. So in these options, you won't get taxed right now. You will be able to defer your taxes. And of course, most people don't know that there are tax advantage options as well. For example, TFSA, tax-free savings account, FHSA, first-time homebuyer savings account. And as I did mention to you earlier, there are life insurance options, critical illness options, and disability insurance options, health, and also when it comes to real estate, you have the primary residence. I have met people, they have group RRSPs, but they didn't know whether to invest or not. They simply lack knowledge. I would say if your employer provides you a group RRSP, please sign up. You should do that right away, actually, because when it comes to RRSPs, not only you will be able to contribute, and that contribution will be can be deducted later from your tax payable amount. The company will match it as well. So, for example, in my company, I get 4%. I contribute 4% to my RRSP, and my employer matches 4%. And that 4% means I get additional 4% of my annual salary from my employer. So don't miss out that opportunity. As well as whatever the gain accumulated in RRSPs are tax deferred. Because you can use this RRSP. RRSP means Registered Retirement Savings Plan. So you can use it for your retirement. And also your contributions, as I mentioned earlier, your contributions can be deducted when you're paying taxes. So you will be able to maximize your tax refund. Similar effect is there for FHSA as well, first time home buyer savings account. The annual contribution limit would be 8,000. So you can contribute up to 40,000. So if you contribute fully each year, you can contribute up to 5 years, 8,000 each. So like in RRSPs, whatever you contribute, you will be able to deduct from your tax payable amount. So then there's TFSA, tax-free savings account. You won't be able to deduct your contributions like RRSP and FHSA accounts when you pay your taxes. However, you will be able to accumulate your funds without having to pay any taxes. So let's assume that you have $10,000 in hand, right? And I'm not going to talk about stock options, mutual funds, and all those stuff. Let's take simple investment options we have. Let's say if you have enough contribution rooms in FHSA account, TFSA, and RRSP, right? So what should be your order? Can I get an answer from our audience? Anyone? Okay, so I would say I would suggest you to contribute first to first-time homebuyer savings account, especially if you are looking to purchase house in near future. So you will be able to contribute up to 8,000, right? And you will be also able to deduct that contribution when you're paying your taxes. And if you have a balance amount, you can use that to RSPs, right? And normally there's a formula to decide the contribution room. When you file your income taxes, you will get to know contribution room available to you, right? And if you have balance, you can invest that in TFSs, right? So I won't talk about mutual funds, stock options, and all that stuff. I don't think most of us have that financial capability and time to invest in stocks and mutual funds. But as I mentioned earlier, if you want to invest in mutual funds, I would say universal life insurance is one of the best option, because you will be able to invest in those funds while getting a insurance coverage as well. So I want to know how to manage your growth strategy. You need to consider these four factors when you are doing investments. First, your rate of return must be high enough to beat taxes and inflation. Otherwise, you will be losing your money. Safety. Manage risk and preserve your principal, which is really important. At least you should be able to get your principal back when you're investing. Tax deferred and tax advantage vehicles can play a significant role in building wealth. In Canada, we have higher tax rates. So if we are able to defer our taxes or get tax advantages, then we will be able to build a significant amount in wealth. Protect your income, assets, and your life. Prepare for long-term care, disability, and chronic or critical illnesses. When saving and investing, consider these important factors. So, building your future. When building a house, you need to make sure all aspects of the house, the foundation, roof, electrical, plumbing, and interior, and etc. All of these factors should work together. The same applies when building your financial future. So normally we do medical checkups time to time, right? So have you ever done a financial checkup? We call this personal financial strategy. So if you do a personal financial strategy or financial checkup, we can come up with a financial strategy which suits your financial situation. This is like a free consultation. You don't have to pay any money, but this way you will be able to identify what are the options available to you, right? And how to build up your financial foundation, which will be eventually help you to have proper protection as well as enough wealth for your retirement. If you have the will, we can provide the vehicle. Financial security is not a dream, it's a priority. So one more note, will your current situation allow you to reach your goals? Consider this, making an extra income on a part-time basis and having multiple sources of income. I told you before that I have a full-time job and this is my part-time business. So let me explain what I'm doing here. So because of this business, I'm having a passive income, as well as since this is a home-based business, some of my home expenses like rent, utilities, car expenses, and things like that, I can allocate some portion of that and claim as business expenses. Right? In that way, I can maximize my tax refund while earning an additional income. At the same time, I get to know more information on how I can how I can design my financial foundation, which now I'm explaining to you as well. Hopefully, if there's someone who is willing to earn some additional income on part-time basis, let me know. I can guide you on how to get how to get provincial license, how to pass provincial exams, and things like that. And the main opportunity or the main advantage of this part-time business is you can start this if you have an open work permit, and with a minimum investment as much as like $100,000, and most of that you only have to allocate to exam registrations and to get provincial license. So in this way, I'm earning my additional $100, which I can use to become debt free, as well as build my emergency fund, and also I can use that for my savings and to build up my investments. So be part of the campaign that's revolutionizing the financial industry with a system that bridges financial education and financial independence. So today I just did an overview on several topics, but in WSB we have workshops. All these are free workshops. We discuss several things, several topics. For example, workshop 1 is building saving and wealth. Workshop 2 is increase cash flow and manage debt. Workshop 3 is regarding preparing the proper protection. Workshop 4 is understanding asset and accumulation strategies. Workshop 5 is fulfilling long-term goals. Workshop 6 is preserving wealth and state. So if you're interested in learning more about these topics, you can register for these workshops. Unfortunately, you have to go through to an agent. I can do it for you. All these are free because right now we are in a campaign to educate 30 million families by 2030. So in order to keep a record, normally you have to get registered to an agent. So with that, we have come to an end. So do you have any questions for me?
Thank you, Prasanna. Let me quickly drop the CPD link.
Do we have any questions in our Facebook comment section?
No, not yet. Yeah, I've dropped the CPD sheets. Yeah, please raise any questions you have.
So if you are interested in learning more about these topics, if you would like to register for those free workshops, just let me know. This is my number. So I will be able to register you for those free workshops, and you will be able to learn more about in detail about those topics which we discussed today. And also, if you want to have a free consultation on how to build your personal financial strategy, you can let me know. You can contact me via this number.
There's a couple of questions coming in. One is, based on your experience, what are some key financial planning mistakes that newcomers in Canada do?
I would say getting into more debt. So if you are starting your journey here in Canada, if you are starting your life here in Canada, you have to be very careful when it comes to your spending, because in Canada or even in US, we have a spending culture. So you have to be very disciplined when it comes to spending. I have seen most of newcomers are kind of trapped in credit card debts. I showed you earlier that how much uh, it can have an impact when it comes to paying credit card interest. If you're able to avoid paying credit card interest, you will be able to use that money to build your emergency fund as well as you'll be able to save some money as for your investments. So my suggestion is try to be disciplined when it comes to spending and try to avoid debt as much as possible.